What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Welcome back to another episode of the CPA Zone. I'm your host, Ryan Pulis, and today we're going to talk about something that's already changing the landscape for real estate investors. That's Opportunity Zones 2.0. It's a new version of the Opportunity Zone program that starts January 1st, 2027. And as always, this is education, not individual tax advice, so make sure you talk to your own CPA or tax attorney before you move money into any type of deal. But let's dive in and start with a quick refresher of the original Opportunity Zone program. So what we call now Opportunity Zones 1.0. So these came into effect with the Tax Cuts and Jobs Act that was passed in 2017. So big picture, Congress wanted to push private capital into struggling communities. So they said if you reinvest your capital gains into certain low income census tracts through a qualified opportunity fund, we're going to give you a generous tax break. So here's how it really kind of works out. This is the Opportunity Zone 1.0, so the original. That's still in effect through the end of 2026. So if you sell something with a capital gain, stock, real estate, business interest, cryptocurrency, you generally have 180 days to invest that money into a qualified opportunity fund. So then the funds go and they invest in an opportunity zone. Now you could invest directly into opportunity zones if you can undertake the project. That's a little bit beyond the scope of what we're talking about today. Most people are going to go into some type of fund. So the fund has certain rules they need to follow. They need to make sure that 90% of its assets are in opportunity zone property or businesses inside of one of the designated areas. So those original designations came out in 2018. Now, there's three main tax benefits under Opportunity Zone 1.0. First, you have the deferral of your original gain. So you have that capital gain. Maybe you sold a piece of real estate. The tax on that gain is deferred until the earlier of when you sell your qualified opportunity fund investment or December 31st, 2026. So you're going to pay the tax when you file your 2026 return in 2027. So that December 31st, 2026 was like a cliff date built into the original law. The next piece is the reduction of the original gain through a basis step up. So if you invested early enough, you could permanently exclude part of that original gain. If you held the investment for at least 5 years, you get a 10% step up in basis. So you're going to pay tax on 90% of the gain. After 7 years, that increases by another 5%. So a total of 15% basis step up. Now, in practice, only the people that invested early, so by 2019, or 2021 could really fully use these because 5 years, you had to hit that 5-year mark by the end of 2026. So to do that, you had to invest by the end of 2021. The 7-year mark, you had to invest by the end of 2019. So anyone that's investing now under Opportunity Zone 1.0, basically that you get the deferral only. There's no basis step up on that original gain that's being deferred. But then the third piece is probably the best is the tax-free appreciation after 10 years. So if you hold your qualified opportunity fund investment for at least 10 years, you can elect to step up your basis to fair market value on exit. So all that new growth inside the opportunity zone deal can be 100% tax-free, including what would be like a depreciation recapture if the requirements are met. So Opportunity Zone 1.0 gave us a fixed deferral deadline, December 31st, 2026, early bird basis step-ups, for lack of a better term, and then a 10-year tax-free exit on the new gain. So it's really been a popular program. It was estimated that over $100 billion have been invested in opportunity funds so far. But there were a few problems. So some of the things were like there's no real reporting. So the funds didn't have to share much data. So no one could really clearly show who was being helped. Some high income areas slipped in just because of technical rules. There were some fraudulent things put together. You're going to see that with new programs. And then the last thing is, the benefits kind of decayed over time. It got worse. If you got in early, you got much better benefits than someone getting in later. So this time, the lawmakers they went back, kind of revisited some of this stuff. And when the One Big Beautiful Bill passed in July 2025, we've got the new and improved Opportunity Zone 2.0. So now Opportunity Zones are a permanent part of the tax code. The high level changes are, Opportunity Zone 1.0 was a temporary program, kind of runs on the old map and has a 2026 deferral deadline, where Opportunity Zone 2.0 is permanent. It's a bit more of a simplified program. It's going to use a new map of zones, which is not yet available. And it starts January 1, 2027. So for an investor, the changes are, one with the permanent program and new 10-year maps. So starting in, I believe it's July 2026, the governors of each state will begin choosing new census tracts to use for the Opportunity Zones. Those will become effective January 1, 2027, and they run for 10 years. So then basically every decade, they're going to repeat, they'll pick new zones. So anything you do with an Opportunity Zone through 2026, you're still under those old rules in the current existing map of Opportunity Zones. Starting 2027, the new deferrals go into the Opportunity Zone 2.0 rules, and there'll be new zones which just aren't available at this time. So another big change for investors is that there's a new rolling 5-year deferral with a built-in 10% basis step up. So qualifying gains that are invested on or after January 2021 or January 1st, 2027 into a new Opportunity Zone, you get this rolling 5-year deferral. There's no fixed date anymore. So basically, your deferred gain, you have a capital gain, you sell a piece of real estate or, some Tesla stock. You can take that gain, invest in an Opportunity Zone fund within 180 days, and then you will not recognize that gain until either one, you sell out of your qualified opportunity fund, or at the 5-year anniversary of your investment. So you still got that 5-year hold period, and you're going to get the step up in basis. So that original gain will be recognized at the early of those two events. You sell out of your qualified opportunity fund or the 5-year anniversary. If you hold it for the 5 years, then you get that 10% basis and step up on that original gain. So you only pay tax on 90% of that gain that you rolled in. There's no 7-year basis step up this time. It's just everyone gets the 5-year 10%. And it's no matter when you invest. You don't have to invest early in Opportunity Zone 2.0. It's just the 5-year hold period. And that main benefit, if you stay in the fund for 10 years or more, that tax-free appreciation is still available. So that hasn't changed. You invest in the fund, you hold it for at least 10 years. All the appreciation that takes place in that fund is tax-free when you exit. So it's very similar. You elect to step up your basis when you exit, and you're going to pay no gains on that appreciation. There's also now a 30-year outside limit. So, you hold it at least 10 to get the step up. But they put a cap on it. So after 30 years, your investment will reset to fair market value if you haven't sold yet. Under 1.0, there was a cutoff of the year 2047. So if you hadn't sold out, you would have had to step up your basis in 2047. Now, the new rules, it's at 30 years. So pretty good deal, especially for long-term projects. Now, some under Opportunity Zone 2.0, we talked about kind of the rules that are applied to typical projects. They also have something called a rural Opportunity Zone, which gets even better benefits. So the definition of rural in this case is generally a census tract that's not in a city or town with more than 50,000 people, and it can't be adjacent to an urbanized area. So I think Treasury is estimated at about 38% of current Opportunity Zone tracts would qualify as rural. So a similar approach is going to be used for the 2.0 map. We don't know what those will be just yet. So the two big perks for going the rural opportunity fund is a 30% basis step up after you hold the investment for 5 years. So instead of 10%, like a standard Opportunity Zone, you get a 30% basis step up. You'll end up paying tax on 70% of the original gain that you roll in. And then this is more for the operators. If you bought a building in an Opportunity Zone under 1.0, you had to put improvements equal to 100% of the building's adjusted basis for it to qualify. For these rural projects, that threshold is now cut in half, so 50%. So less improvements required to meet the rural qualified Opportunity Zone and again, that's as investors, you're going into a fund that the people that are really running the deals and operating them, they've had this improvement threshold to hit, which for the rural opportunity zones is now half of what it was. So if you buy a used building in a rural opportunity zone for $5 million, you only need to put in 2.5 of improvements to meet the test rather than a full $5 million. So between the bigger basis step up and easier improvement tests, there's a lot of interest in these rural deals. So I think it'll be something to watch for, and it could be pretty interesting, especially as deals start to open up. Now, another thing they addressed, there's going to be a lot tighter reporting requirements on those fund operators. So one of the biggest complaints under Opportunity Zone 1.0 is we don't know what's actually happening in these zones. So the opportunity funds are going to now have to report things like total assets and investment amounts, approximate housing units created, employee counts, job metrics, and various other things. There'll be penalties in place if they don't file the reports. And basically what they're trying to do is make the opportunity zones more measurable and accountable. So now let's just kind of take a look at a couple quick examples of what this would look like for an investor. So let's go into a standard deal, non-rural, under Opportunity Zone 2.0. So let's just say early 2027, you sell an apartment building, you have $1 million long-term capital gain. You invest that into a non-rural opportunity zone under the 2.0 rules within 180 days. So you're going to defer that $1 million gain until early 2032, 5-year anniversary of the recognition date. If you keep holding, you hold it that 5 years, you defer the gain, and at that 5-year mark, then you get the 10% basis step up. So now only $900,000 of that original gain is taxed. If you hold the qualified opportunity fund interest at least 10 years and then sell, you pay no federal tax on the future appreciation. So if that $1 million grows to $2 million by year, I don't know, let's call it 11 or 12, you pay tax on the $900K, when it's recognized at year 5, but zero on that extra $1 million in growth. Now, second example, let's just say it's pretty same setup, but in a rural opportunity zone, same $1 million gain, but now it's into a rural opportunity fund. After 5 years, you get a 30% step up in basis rather than 10. So now only $700,000 of that original $1 million gain is going to be taxable. $300,000 is permanently excluded. And if you hold for 10 years, all of the appreciation is also tax-free on exit, just as it would be under a traditional opportunity zone that's not rural. So a little bit better deal out there on the rural opportunity zones. I think this is going to be an exciting thing to watch and keep an eye on over the next few years as the program gets rolling. That about does it for today. If you've learned something new, make sure to hit the subscribe button, share the episode, and leave us a review. Until next time, have a great day. Are you interested in becoming a client? Click the Discovery Meeting link in the show notes to schedule a free call to discuss our services. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's ThePulicegroup.com/contact.